In this video, we will explore about option pricing fundamentals. You might wonder how the price of an option premium is decided and if it is fixed by an exchange or a regulator. The truth is that these prices are determined by buyers and sellers in the market through a process called price discovery. When you look at an option premium, it is actually made up of two parts, which are the intrinsic value and the time value. A very important rule to remember is that as long as an option has not reached its expiry date, it will always have some amount of time value. To understand why these prices move, we need to look at the variables that impact them. There are 5 fundamental parameters that determine the price of an option. These include the spot price of the asset, the strike price you choose, the volatility of the market, the time remaining until expiration, and the current interest rates. Whether you are looking at American or European options, these factors will influence the premium in specific ways. Let us start with the spot price of the underlying asset. The premium of your option is directly affected by how the price of the actual asset moves. If the price of the underlying asset increases, the value of a call option goes up while the value of a put option goes down. For example, if an index rises from 17,500 to 18,000, a call option with a strike price of 17,500 will see its price increase. On the other hand, the price of a put option with that same strike price will fall. The next factor is the strike price. For call options, if all other factors stay the same, a higher strike price means a lower intrinsic value, which leads to a lower premium. For instance, when the market is at 17,562, a call option with a strike price of 17,600 will be more expensive than one with a strike price of 17,700. It works the opposite way for put options. A higher strike price increases the intrinsic value of a put. So a put option at 17,700 will trade at a higher premium than one at 17,600. Volatility is another key element, and it represents the size of the price swings in the asset, whether they go up or down. High volatility is actually good for the price of both call and put options. This is because when the price moves significantly, there is a much greater chance that the option will end up in the money. So, when unexpected events cause market volatility to spike, you will see the prices for both calls and puts increase. We often refer to options as wasting assets because of the time to expiration. As each day passes, the time value of an option gradually drops, eventually reaching zero on the day of expiry. This is why a longer maturity usually means a higher premium, as there is more uncertainty and more time for the price to move. This constant loss of value is known as time decay. Because of this inherent tendency for the price to drop as time runs out, option sellers often have a natural advantage over option buyers. Interest rates also play a role in how options are priced, though the impact can be a bit more complex. Generally, when interest rates are high, it leads to an increase in the value of call options and a decrease in the value of put options. This happens because the interest rate affects the cost of funding the underlying asset, which influences the overall carry cost and the final premium. The impact of these rates can vary depending on whether you are trading options on stocks or options on futures. Now that we understand the basic factors, we can use tools called the Greeks to measure how sensitive an option is to changes in the market. These Greeks help us quantify the risks and potential rewards. We specifically track 5 main Greeks, which are delta, gamma, theta, vega, and rho. Each one represents a different type of sensitivity, such as sensitivity to price, time, or volatility. Delta is the most vital Greek to understand. It measures how much the option value changes for every 1 rupee change in the price of the underlying asset. For a call option buyer, delta is positive, which means the contract gains value as the price rises. For a put option buyer, delta is negative because the value increases as the price falls. If a call option has a delta of 0.60, it means a 1 rupee increase in the stock price will result in a 60 paise increase in the call price. Gamma acts like the acceleration of the delta. It measures how much the delta itself changes when the price of the asset moves. You can think of it as the speed at which an option moves toward being in the money or out of the money. For example, if a call option has an initial delta of 0.50 and a gamma of 0.08, a 1 rupee increase in the stock price will push the new delta to 0.58. Theta is the Greek that measures sensitivity to time decay. It tells you how much the price of an option will decline for every 1 day decrease in the time to expiration. Since options lose value every day, theta is usually a negative number for long positions. For instance, if an option has a theta of 1.2, the price of that option will drop by 1 rupee and 20 paise for every day that passes, even if the asset price does not move. Vega measures how much the option price changes based on market volatility. Specifically, it shows the change in premium for every 1% change in volatility. Vega is positive for both long calls and long puts. This means that if volatility goes up, the expected reward for the position increases and so does the premium. If an option has a Vega of 0.80, a 1% rise in implied volatility will lead to a 0.80% increase in the premium. Finally, we have Rho, which measures the sensitivity of the option price to changes in interest rates. It specifically shows how the premium changes for a 1 percentage point change in the risk-free interest rate. Rho essentially tracks the change in price per unit increase in the cost of funding the underlying asset. Understanding all these Greeks together gives you a complete picture of how your option price might behave in different market conditions.